Different types of fraud schemes. There are various types of fraud schemes which fraudsters accept to perform fraudulent activities. The following listing of possible fraud schemes can be utilized by management and auditors to assist in identifying possible fraud risks and scenarios when assessing fraud risks. Fraudulent financial reporting schemes. Fraudulent financial reporting schemes aim to change the form and substance of the organization's financial transactions and financial statements. Fraudulent financial reporting schemes include side agreements. Sales terms and conditions may be modified or otherwise amended, which may impact revenue recognition. Common terms modifications may include granting of rights of return, payment terms, exchange, or refunds. In the ordinary course of business, sales agreements can and often are legitimately amended. There is nothing wrong with giving purchasers a right of return or exchange, as long as revenue is recognized in the proper accounting period with appropriate reserves established. Round-trip transactions. Recording transactions that occur between two or more companies, for which there is no apparent business sense, purpose, or economic benefit. These transactions are often entered into to inflate revenues or show strong growth in sales. Such transactions may include sales between companies for the same amount or involvement of a loan to or investment in a customer to purchase the goods. Cash may change hands, but payment alone does not legitimize the transaction or justify the recognition of revenue if there is no underlying business purpose or economic benefit for the transactions. Alteration of shipping documents. An organization may record false sales transactions and recognize improper revenue by creating false shipping documents. By altering the shipping dates and terms of shipping documents, a company may increase its revenue shown in a specific accounting period. Bills and holds. A bill and hold transaction occurs when products have been booked as a sale, but delivery and transfer of ownership do not occur as of the date when the organization records the sale. Such transactions may involve a legitimate issuance of sales or purchase orders. However, the customer may not be willing or able to accept the delivery of the product at the time the sale is recorded. Failure to record sales provisions. Some sales transactions require companies to record sales provisions to account for future sales returns. By failing to record sales provisions, companies may improperly overstate their revenues. Some sales transactions require customers to pay upfront fees for the services that will be provided over an extended period. Organizations may attempt to recognize the full amount of the contract before the services are performed, which means before revenue is earned. Such schemes may involve the modification of financial records such as purchase orders, sales invoice, and sales contracts. Misappropriation of assets. Misappropriation of assets is a scheme of fraud where assets are misused or embezzled by the organization's employees. Misappropriation as assets include skimming of cash. Cash skimming schemes involves the sales cycle where employees embezzle by not recording the sale or full amount of the cash collected, such as a retail store where an employee collects cash from a customer, pockets the money, and avoids recording the sales transaction. Fraudulent disbursements. Such schemes may include procurement frauds, theft of the company's checks, ghost employee schemes, and wrong expense reimbursements. An example is establishing fake vendors or suppliers in the accounts payable system, or approving payments for services not received. Other fraud schemes. There are various other fraud schemes which may be committed by the employees of the organization, such as bribery, corruption, and kickbacks. Corruption and bribery within an organization can include vendors paying gratuities to buyers to secure sales, buyers paying premiums to vendors because of buyers' relationships, and payments made to shell companies for soft services that are not rendered. Money laundering. Money laundering is the process of concealing the actual source of black or illegally obtained money. This process enables the criminals to enjoy profits without revealing the actual source of income or funds. Money laundering funds may come from insider trading, bribery, computer fraud schemes, illegal product sales, smuggling, and other organized crimes.